You know, a lot of the superlatives we're citing today go back to early and mid 2020. The market and the economy then was in a much different place then than it is now. And I'm curious as to why we're still seeing these types of severe sell-offs here in 2022.
Well, I think one of the main things is that we had, the Fed people talk about, well, the Fed make a mistake and tighten too much. Well, I hate to say it, the Fed had already made the mistake when they kept the liquidity, the liquidity spigots open at emergency levels long after the emergency had passed. And so that pushed the market up well above the underlying fundamentals. And so therefore, now that they've cut back, got rid of the liquidity, they're cutting back on QE and raising interest rates. So we have the exact opposite. So you'd expect this market to come down. And one of the things is that the bond market had already priced that in with the severe moves that it's seen. But until recently, the stock market really hadn't. So it's just finally starting to do that. Having said that, we saw a 35% decline in the S&P back in 2020 when the economy had just fallen out of bed. I would be shocked if we saw that kind of decline this time around because the economy is in much better shape.
And Matt, I remember a few weeks ago when we were looking at the 200-day moving average, a lot of people saying that maybe we'd find some support there. The S&P 500 now down 9% below that measure. I mean, when you look at a market like this, is it even possible to perform technical analysis? Is there any tea leaves to read here?
Sure, there is. I mean, well, one of the things we do have to worry about, of course, is that if we get a flush, and a lot of people like to see that capitulation and that flush in the marketplace. You don't always get it, but you usually do when you get the kind of the kind of leverage that we've seen in the market. We saw that with margin debt. It's starting to come down. Well, people don't get margin calls when the market's down 5% or even 10%. It's when it gets down about this much. So, and then you get the forced selling. Well, people have to meet margin calls, and the market gets hit. That I'm not saying we're going to go down 50% like we did, 12 years ago. But what I'm looking for, though, is that we could get, that kind of a flush. And you see, look at the technicals. You look at, I think, at the 380 level on the S&P 500 is not out of the question. I don't know that we'll get it soon. Nothing moves in a straight line, but I do think a drop below 4,000 is something that is probably likely before we see the ultimate bottom.
The big sort of sell-off has pushed the Nasdaq 100's forward PE ratio back down to levels that we haven't seen since about April 2020. Romaine brought up a good point, is what fundamentally is different between now and April 2020? Do those ratios make sense, or is this just a sort of a huge revaluation and we're still nowhere near sort of those long-term averages of where the appropriate valuation should be?
Yeah, I mean, with interest rates moving back up, I mean, we have to be cognizant of the fact that, that was one of the reasons. I mean, when I got into the business many years ago, 17 times earnings was considered very expensive. But of course, interest rates were in double digits back then. But the point is, even though interest rates are low on a historic basis, they're still much higher than they were when they were at 0.5% not long ago. So we have to have that revaluation. But also, because there was so much leverage in the marketplace that I talked about, you usually get the pendulum to swing to the other side. It usually doesn't stop at fairly valued. It pushes at least a little bit into undervalued. And so again, we have to be careful of that. But don't fear this thing. Try to embrace it, and therefore you won't be the one who's selling at the bottom. You'll be the one buying and taking advantage of it.
I am curious, though, Matt, whether some of the fear here is tied directly to the idea that the Fed does not appear to be ready to come to the rescue of the market, at least not to the extreme that it was willing to do in past cycles here. The idea of that proverbial Fed put, whether it was real or not, the idea right now is that it does not exist, or at least it exists at a level that's well below 4,100 on the S&P.
Yeah, I think that's a real fear, and I think it's a legitimate fear. I mean, look at it. The people keep starting saying, or some people saying, "Hey, geez, we're starting to see signs the economy is slowing." We saw the GDP yesterday, and so therefore the Fed will come to the rescue soon. But they're not tightening because of that the economy is too strong. They're tightening because of inflation, and with this war in Ukraine, all these supply chain issues and other inflationary issues are going to be with us longer than they thought at the beginning of the year. So that's the fear, that the Fed is going to have no choice but to tighten further, and because of this fear of stagflation, and that's going to cause the market to fall further than it has. And again, bear market, deep corrections of bear markets are normal. They're healthy. They're scary and painful, but people want to take advantage of them rather than fear them.